Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for September 20th, 2015. Market remains in bare volatile conditions, so we've shortened up our time horizon and reduced our swing trades and positions in the longer term systems. On an annual basis, using weekly RSI 14, score is 40 out of 100, so the lower end of neutral. On a 10-day basis, using the 10-day NDX, it's in the middle of neutral, also at 43 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is red bearish at minus 4.55% with a negative slope on the 50. ADX is still strongly trending downward at 28.8. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. Current reading is at 0.984. which still puts us in risk off, but as you can see from the histogram of the risk Z, where we take the average and standard deviations to compute a Z-score, it's moved from a negative 4 sigma all the way up to just under the zero line. So stability at this level would not be surprising, which would lead us to conditions for improved swing trade positions now. Still a volatile market, but definitely volatility is leaking out. No change to blended monthly rebalancing or the ETF2, which is at 0% theoretical exposure, and the model portfolio itself is at 10%. The next rebalancing for BMR is due on or about 1 October. Just a quick look at the carnage that's left in the main indexes using the BMR lens. You can see some of the major indexes starting to make a turnaround. Consumer discretionary staples looking good. In ETF Max, again, some extraordinary volatility here. You can see just the size of the moves over the 1 week time frame. This total return sub-index is of interest to me now because of that major move. Total volatility index here, get a big smackdown. You can see that in the volatility decay in the risk Z. Since that's been happening over the last 2 weeks, just want you to observe that there are reasons why you may want to consider volatility trading. In the S&P 500, this is a quick look here. Cablevision, Amazon, Tico Energy remain up near the top here. Netflix starting to make its little recovery once more, as is Expedia and Regeneron. Looking at the health check, we have market still underneath that 200-day moving average. Our vertical blue lines are 10, 20, and 30 days worth of look back. You can see the slope of the 10-period regression line is up despite this pullback on Friday. Thanks, Fed. Looking at price targets to the upside of 204, which was the beginning of this collapse here a couple weeks ago, and then all-time swing high up here around 212. If it falls out of the river around 192, then I would get seriously short side bias as it is right now. I'm leaning towards the short side. I'm ready to go short on any new intraday low or a breakout of a previous day's low on momentum for short-term trading. Placed in fair value right here around 196, the middle of the dragon, which is in the lower half of the river. River sloping definitely downward. The slope of that 30-period regression line, you can see, hit an extreme down here at about a minus 0.75 and is now rolling up. It's still an extreme downward slope, but not anywhere near as bad as it was before. And you can see that the 10-period is indicating some upward pressure, except for the Fed. Jaws of PPO are to the upside. So again, this is still a tactical trader's market. I prefer a shorter term time horizon. We've been grabbing them when we can get them intraday in the chat room. Reluctant to hold positions overnight. If we do, it's because it's funded by markets money with a wide stop to respect the volatility. I see no reason to change that outlook right now. You can see everything in ETF2 is on a cash position. Most of the U.S. index sector spiders are above average with the exception of energy and industrials. Strength in utilities and discretionary. I'm still waiting to see some recovery here in healthcare. Once this volatility completely drains, I think there'll be some buy on dip opportunities emerging there. You can see in the market health check, the world market model here, we got all of the U.S. value plays are below average, as is small cap blend, everything else above average. Weakness across the board in Asia with the exception of Japan, Belgium, and a couple of the European countries above average. Brazil just getting the smack down. It just continues. Treasuries, corporate bonds, gold and silver making a bounce along with real estate and private equity. ETF2 tells the same story as the BMR lens, so I'll leave that to you to review. These are really essentially dominated by the short-term bonds. Inside the Dow 30, new leaders in United Health and McDonald's. So United Health might be the one where I'm looking for early strength and continued strength in healthcare sector. Otherwise, Nike, Goldman Sachs, Visa, Home Depot, the winners continue to win. DuPont, Chevron, United Tech, Walmart, Caterpillar picking up the bottom five. Intel is of interest on the white and the yellow, so it's starting to emerge from the pack and still has room to go, though, before it gets back to the top. Shifting to the daily report. Just a handful of dojis and an inside day. There's 4 signals on the RSI2 and a handful of auto framers that look pretty good. Some overreaction short signals here in gold, real estate, and silver. That's sort of the flight to quality or the flight to alternate asset classes being reflected there. You got a 5DD in agriculture, DBA, and just a couple here that test out well on the auto framer. Auto framer stats and the regression line fractal framework for the these on the top shelf are the ones that are the most numbers of ATR below their own RL270, so I'd look at these as value opportunities. And the ones in the red, the bottom shelf, are the ones how many ATRs are above their 270 regression line, and negative reward to risk being around 0 here means that they're very close to their long-term fair value. The daily squeezes, some symbols of interest in here in the healthcare and technology and financial, so I'll be looking very close at an excursion from there. I think we're going to see some sharp moves on Monday now that people have had a chance to digest the Fed's messages over the weekend and are going to start making their moves, I think, early. So very little conviction over the weekend that the bulls and bears essentially zeroed out after the little system shock from the Fed. Volatility coming back almost within 2 standard deviations now for the long-term trends, and you can see that the standard deviation divided by price, that SD percentage, if you will, has rolled over in an extreme location. The crossover of that 30-period regression line slope and its own 10-period moving average happened 3 standard deviations away from the long-term average, and so that has usually been a good early warning for a change in trend. So the upside to me is starting to begin to look attractive once more. Some quick reference stats. You can stop the tape and look at them if you need to. XLV showing some strength here in the green over the last 10 days. So I think healthcare is healing. Physician, heal thyself. Made a nice move back into the river, which has adapted downward. I think that rising trend line connecting the lows is still intact, so I would not be as surprised to see a move back up here around 205. I like that the 30 has reversed. The 10 has been showing some resilience, and the longer term shows this as an opportunity to go. It's hard to move the 90 period regression line that far out of the historical trend. And so when this crossover occurs, I think we're going to get another signal that the upside's looking good. Quick look at the frogs and the holding periods, intraday percentages. And that's everything I want to cover from the daily. Thanks for your kind attention. Keep your risk measured and your powder dry. The folks are doing some terrific work inside the chat room with the daily intraday trade with volatility pairs. It definitely deserves your attention. Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.